For those of you who do not know me, my name is Margene Zink, and I'm a partner with Kruggel Lawton. My home office is in Elkhart, but I also spent a little bit of time in South Bend at the beginning of my career. So I am one of the leaders of our firm's nonprofit practice and handle most of our engagements here in Indiana. The first session is the new standard on the presentation of not-for-profit financial statements. So first of all, by a show of hands, how many of you had heard of this change coming before you received our email to come today? Good, excellent. And of those of you who have heard of it, how many of you have actually done some research or sort of read up on these new standards? Good. So we'll cover some of the major points with these standards. We'll get into some of the details, but as always, it's always good if you want to dive in yourself and look at those minute details that we might not cover. So the effective date for the new standard on financial statement presentation is for years that are beginning after December 15th of 2017. So this is a statement that is effective for 2018. If your calendar year began on January 1st of 2018, this will be effective for your 2018 engagement. If you are a fiscal year end, most fiscal years are on the July to June basis, but it would be for your fiscal year ending on June 30th of 2019. So you guys have a little bit more time to think about this as your year just actually started. There are some transition provisions in this standard. So if you were to early adopt, which obviously we're already into the year of adoption, but if you, for some reason your financial statements aren't done for a prior year, you could choose to early adopt the standards. But there are some provisions that go along with that. You must apply all of the provisions of the standard. So you can't pick and choose the 5 items that we're going to go through on the next slide. You'd have to apply all of them, except for if you were doing a comparative statement, you could choose not to apply 2 of the 5 different attributes, which would include not applying the provision for the nature of the functional expense statement. You wouldn't have to apply that to the prior year. And then you could actually opt not to do the liquidity and availability disclosure either. I should qualify that by saying that does not apply to healthcare organizations because healthcare organizations were already required to have a functional expense statement. So you will need to also be putting in a footnote in your statements this year that describes the adoption of this standard, basically just stating that the organization has applied the new standard that's effective. So you do have a couple of decisions that you could make as you look at your 2018 financial statements, whether or not you want to do a comparative statement, just thinking about those transition provisions. So if you're presenting your 18 statement, how do you want to apply that to 2017, which will be comparative? Or do you just want to present a single year statement and not have to worry about that prior year presentation? And then if you have any restatements that might be necessary because of the new standard. So the 5 key provisions of the new standard, the things that are affected, one is the presentation of the net asset classifications. There's also a provision for the presentation of the cash flow statement, presentation of investment return on the statement of activities, the presentation of expenses by function and natural classification, and disclosures for liquidity and availability. So the first provision for net asset classification, this is going to move your statements from having 3 classes of net assets to 2 classes. Okay, so previously you had unrestricted, temporarily restricted, and permanently restricted. Now, under the new standard, you're going to go to 2 classes, which are going to be with donor restrictions and without donor restrictions. And so what this means, practically speaking, is you're going to take your unrestricted net assets and you're going to put them into the category of without donor restrictions. And then your temporarily and permanently restricted net assets will go under the with donor restrictions category. So why did they do this if it seems so simple? So the standard basically comes from the idea that when you're looking at temporary restrictions and permanent restrictions, it's hard sometimes to delineate between the two. And so they said, why do we constantly try to put these things into these two different buckets? Why don't we just call it one bucket, and then we'll describe what's in that bucket. So along with the presentation change that you have on the statement of financial position, then you'll describe what's going on in those two buckets back in the footnotes, which we know everyone reads the footnotes, right? The 30 pages of footnotes that are attached to your statement. If you ever have trouble getting to sleep, read your footnotes. So the supplementary disclosures that you'll have can include the breakdown of what's in those two categories. So, or you could also actually choose to present those on the face as long as you're showing those two kind of master categories. So some of you may choose to have this title on your statement of financial position that shows without donor restrictions, and then you'll break down, unrestricted, operating, board designated, whatever falls under that. Or some of you may just choose to present just the one line. And then same for the with donor restrictions, you may choose to present, the different categories of all of the restrictions that you have, as long as you have that one master category. So what that will look like is what's shown here on this slide. So you have your net assets with donor restrictions and without donor restrictions here. And again, if you chose to, you could actually include some subcategories here with line item amounts to break that down further. So we do have an example of what's going to happen with the statement of activities. So with the statement of activities, depending on how you've done your financial statements in the past, you may actually have statements that are presented in a columnar format, or you may be presenting statements that are a top-down approach. So this is shown in the columnar format here, where you have just the two columns. So before you would have had actually 3 columns shown there for the 3 different categories. Now you're just going to move to 2 on the statement of activities as well. If you're doing the top-down approach, which just starts with your unrestricted at the top and moves down through your categories, you're just basically going to have the 2 sections, one at the top for without donor restrictions, and then move down to your with donor restrictions, and then keep moving down. So as I mentioned, it's also going to affect when you're doing comparative year statements the prior year as well. So this is presentation of the prior year, and you can see it basically looks exactly the same as the current year. You're still going to need to go in and do this same change for the prior year if you're presenting comparatively. For the disclosures, you're going to, again, want to include detail in your disclosures of the amounts and purpose of the items that are in each category. So if you have unrestricted net assets and you've got a bunch of categories underneath that, as I mentioned, board designated or whatever else happens to fall under there, you're going to want to put that in your footnote and describe back there what's going on in that bucket. And then the same for the with donor restrictions. You're going to describe all of those restrictions, whether they're temporary or permanent. It's all going to become part of that one bucket. There's also a change in relation to underwater funds. So underwater funds, as we know, Those occur when the value of a fund is less than the historical value that's been determined needs to be retained, either from the donor or by existing law. So this was obviously part of UPMIFA, the Uniform Prudent Management Investment Fund Act, of Institutional Fund Act, sorry about that. So that, the designation for the underwater funds previously, when you had funds that were underwater, that would go through your unrestricted net assets or net assets without donor restrictions. They've made a change in this presentation so that now, if you do have those funds that are underwater and you're disclosing that amount or incorporating that into the financial statements, it's going to go through the category with donor restrictions. So this may cause a reclassification in your financial statements if you do have underwater funds. You're going to have to move those net assets that previously went into the unrestricted category to now this with donor restriction category. Clear as mud. Along with the change for the presentation of that amount by which the fund's underwater, you're also going to need to make disclosures regarding the aggregate amount of the original gifts that, again, was determined by the donor or by law, and then also the fair value of those funds, and then any provisions that you've adopted to reduce or to not spend those funds. There's also a change in relation to capital restrictions. So let me first say that this would apply anytime there is not an exact donor directive. So as we know with nonprofits, basically everything that we're doing in relation to donor funds is driven by the donor restriction. Whatever that donor directive is, that's how you're accounting for it. In the absence of an explicit donor directive, some entities actually chose to present these capital restrictions or release them based off of time. So that is now gone. So if there are no explicit donor restrictions or guidance, you're going to now release those restrictions when the asset is placed in service. And then if you're presenting operating versus non-operating amounts, you're basically going to amortize that amount from non-operating into operating. Are there any questions on the first section regarding the net asset presentation before I move on to the second item? Excellent, I must have explained it very well. So the second section that we'll deal with here is the statement of cash flows. So when the board started discussing this new standard, they were contemplating making all nonprofits move from presenting on the indirect method to the direct method. However, I think thankfully from our perspective, they decided to retain the option. So you can still do either the indirect or the direct method. The one change they did make is if you do the direct method, you no longer have to include the indirect reconciliation that would come at the end of the direct method statement. So one of the reasons I think that they retained this, actually the standard setters prefer the direct method because they think that it's just more clear exactly where cash is going. But one of the reasons I think they retained this option was basically because the direct method can actually be a little bit more complicated to figure out. Entities generally don't track the information that goes into that statement just in normal operations. It's sort of an extra step they have to do. So if you do contemplate making a change from indirect to direct, I would just suggest maybe thinking about what is important to the users of your financial statements. What does the board want to see? You can have those discussions internally and determine if you want to make a change. I will say probably 98, 99% of our clients, including some of you in this room, present on the indirect method. I do have a couple that are on the direct method, which is generally driven by a specific standard or reason. They're generally forced to present that way, not because they're choosing to present that way. So some entities with HUD funds are required to present on the direct method. It's just part of their HUD standards. So the next session here that we'll go over is investment return presentation related to this. So the new standard will require a netting of investments against the return from investments on the statement of activities. So if you're presenting your investment return there, you're just going to go ahead and net your expenses into that. You can show them separately on the statement of activities if you wish to show two different lines for whatever reason, if you choose to do that, but it will need to come to a net total. So what is the investment expense that gets netted into that? It would be any direct investment expenses that you have that you're paying to third-party brokers. So anything you're identifying directly from statements, things like that, or indirect internal expenses. So indirect internal expenses are going to include anything where someone might be directly involved in generating investment return. So you could have salaries and benefits, travel expenses, and things like that for someone internally that deals with your investment situation. It will not include people who are just basically tracking investments and reporting them in the statements. So you can relax all the accountants who are, doing spreadsheets, things like that. You do not need to allocate that time to the indirect expenses that you're reporting here. It does away with the requirement to disclose the investment expenses. So previously you had to include that expense in the footnotes. And you no longer have to disclose the income components either. This does exclude programmatic investments. So I know at least one entity in the room has a programmatic investment. And basically programmatic investments, in case you don't know what they are, generally pertain to loans or equity interests or guarantees, basically that have been made to either a related organization or some organization in which you have a vested interest that's furthering your own mission. And generally it's at rates or things that you wouldn't generally enter into if you weren't somehow connected with that organization. So you might give them a below market rate loan, something like that. So this provision to net those will not include programmatic investments. And then we're going to talk about next the presentation of the functional expense statement. So this will make a little bit more sense when we get into that. But there are some items that you would include in the functional expense presentation, even though they're on the face of the statement of activities. Investment expenses is not one of them. So you will not include investment expense in your functional expense presentation. So the next section is on expenses by nature and function. So currently, many organizations already have a functional expense statement, but some of you do not. Some of you may be just presenting functional totals on the statement of activities and then maybe including a breakdown of your natural expenses back in a supplementary schedule, or you may be including the natural expenses on the statement of activities and describing the function in the footnotes. The new standard will require everyone to go to a presentation where you're showing both nature and function in the same area. So wherever you're presenting that, you'll need to be together. So what we think is this is just going to lead basically most organizations to do a functional expense statement in their statements, because otherwise I think it'll get clumsy trying to present all of that information either on the face of the statement of activities or putting it in a giant footnote. It's going to look the same as a functional expense statement, really. So I think that will probably be the easiest way to accomplish what's required in the standards. There's a note here, it can no longer be a supplemental schedule. So if you're currently doing that where you're putting it in the supplemental schedule that comes after the footnotes, you'll have to make it part of your basic financial statement, which would be everything before your footnotes. So one of the reasons to think about this is obviously you have a functional expense statement that's already required in the 990. So for those organizations that are filing a 990, which I think would be most of you, you're already doing that breakdown for 990 purposes anyhow. Now, given the rules that dictate where those items fall on the 990, which line items they're in, are often different than how they're presented in the financial statements themselves, but it's the same concept of getting all of your expenses into a functional classification. So when I talk about function, that's program, management in general, and fundraising. Your natural categories would be like your salaries and wages, repairs and maintenance, office expense, depreciation, things like that. And so your auditor is going to spend a little bit more time here because it is now part of the basic financial statement, so we will have to look at that a little bit more closely. But what I would recommend is considering internally how you want to go about implementing this change. So if you don't currently or haven't in the past done a time study to figure out where people are spending their time and how to allocate those expenses, that may be something that you want to consider. Not mandating that, I'm just saying that's an option to consider that. If it makes more sense to divide your expenses up or allocate them based on square footage, you'll want to have some sort of analysis that supports how you're getting them into the different categories. So you just need to think about what method you're going to take to accomplish this requirement. The key concept with management and general expenses hinges on direct conduct or direct supervision. So you may have people who are in management and general type positions who are spending time on program or fundraising activities. And so you may want to allocate some of those costs to those other two functions, which is fine. You just need to basically come up with some method by which you're going to do that. So you need to consider their direct conduct and their direct supervision or production as it relates to program activities or fundraising activities. You're going to have to connect that. So I mentioned earlier, if you have expenses that are presented on your statement of activities in other line items, then you're going to also need to include them in your statement of functional expense. So currently this isn't generally done. If you've presented it on your statement of activities as a net of another item, you typically have not reported that in with the functional expenses because the total that's being pulled from the functional expense statement to the statement of activities is just whatever it is and sort of foots down. Now, if you have items that are occurring in those other categories, so let's say for whatever reason, I know it's rare with a nonprofit, but if you have cost of goods sold and you have salaries and wages that are part of that cost of goods sold number that's on your statement of activities, you're going to need to actually pull that out and put it in to your functional expense or your however you choose to do that analysis, and do that by function and nature as well. So you may end up with like where you have things added in that you come to a total that you later back out to come to a total that then flow up to your statement of activities. They want to see that all by nature and function. As I mentioned before, don't include your external and direct internal investment expenses in that presentation. But then you'll also need to include qualitative disclosures as it relates to the methods that you've used to allocate the costs, again, back in the footnotes. So the presentation that we show here on this slide shows one option for something you might include in your footnote to describe how you've done that allocation, with expenses down one side and then the method of allocation down that other side. And so I think, Yeah, so we've got an example of the statement of functional expense here. So if you choose to go with the statement of functional expense, this is what it would look like. And you can actually do this one of two ways. So this is presented with the natural expenses down the left side and then the functions across the top. But you could actually choose to do that in the reverse if it made more sense. And you may notice too, so some entities have historically only presented just one category. This may just say program services on your statement of functional expense. Or you may have maybe 10 different categories here that represent program expenses. I would encourage, as much breakdown as you have access to present there for program expenses, but you do what makes sense internally. So some will have more than others. And then obviously, again, you have your management in general and your fundraising expenses. The statement of functional expense, again, I mentioned earlier, some of these provisions already applied to healthcare organizations. Healthcare organizations were already required to present statements of functional expense, so there's no change there for you guys. So going back to the management and general expenses, here are some examples of management and general expenses that you may be choosing to allocate across categories depending on what's involved. You wouldn't allocate all of these probably, but again, there may be people who are working in these areas that are also performing program expenditures that you would in fact want to allocate time for. So here, producing and disseminating the annual report is a management and general expense. And then all other management and administration except for direct conduct or program services, fundraising activities, or membership development activities. Any questions on the statement of functional expense presentation? As I mentioned, you're already doing this functional expense presentation for the 990, and the reason that's important, obviously, is because your 990 is publicly available. So anybody can go out and pull your 990 down off of guidestar.org and look at that functional expense statement, and frequently what they're looking for is how much money do you spend in the program area, how much money do you spend on management and general expenses, and how much money do you spend on fundraising, and then they'll make giving decisions based off of your presentation in that statement. And so it becomes important because obviously if they go out there and look at that and they see that your management and general expenditures are much higher than they would expect, they're not going to give you money, or they may choose not to give you money. So it has a direct impact on what's coming into your organizations. And so I actually think perhaps this is a good thing that they're going to this function and nature classification, even in the financial statements, because I know some of you also make your financial statements available either on your website or through some other means. And so you obviously always want your donors to see sort of the best picture of your organization. So doing some sort of time study or something to allocate these effectively will be important as you put things into those categories for presentation to the donors. Now, could also lead some organizations to manipulate that presentation, which is why your auditor will be looking at it. So in terms of implementation and reporting expenses, what should you do? Review your allocation methodologies to determine any changes that are needed. Decide how to present your analysis in the financial statements. So again, either on the face of the statement of activities, in a footnote, or just present the statement of functional expense. And then evaluate your programs and supporting activities to make sure that your presentation is accurate and complete. And then also draft your footnote that contains your methodology for how you went about allocating those expenses. I would encourage you not to wait for your auditor to draft that footnote for you. we'd be happy to help. But it's always good when you've sort of already taken that initial look at things. So the last section of the new standard deals with liquidity and availability presentation. So this is new, I think probably for most everyone, unless you're sort of including voluntary information in your footnotes before. So the new standard includes both quantitative and qualitative information. So the quantitative, the presentation of that could be a little bit easier to get at in terms of it's sort of more concrete. And then your qualitative disclosures basically is how will you communicate what you have on hand as of your statement of financial position date that can be used to satisfy liabilities and expenses in the next operating year. So how do you let your readers know what is available from your available assets? You're going to include that in your disclosures. So what is available, what's not. You're going to disclose any requirements for cash to be held in separate accounts, any sort of interfund borrowing that you've done in relation to if you have taken restricted funds during the year and used those for operations because you've had a temporary cash shortfall. You'll be presenting that in your footnote. And then any limits that come from contracts or covenants, or anything else that comes to mind that might apply as you're doing this. So the disclosure options that you have two options for the format of how you want to organize your quantitative disclosure in your footnotes. You can either start with all of your available assets and then back off what is not available either through donor restrictions, board designations, whatever covenants, any sort of requirements like that, so that you kind of arrive at this net number down at the bottom of what is available. Or you can choose just to present, hey, these are the 5 items that I know are available for next year. So this could kind of lead to an aha moment for many organizations, because I know that some organizations have large amounts of assets, but they've already been committed either through restrictions or through board designations for particular purposes. But when readers of your financial statements may look at it, if there's not enough detail in there, your board members may think, oh, we've got $10 million to spend however we'd like, when the truth is that you really have somewhere less than 10 million because you've got restrictions, you've got board designations, other things in there that have those assets are already spoken for. And so this will help with some of the understanding of what is actually available to spend. So this is the presentation that I mentioned where you would have your financial assets as of year end shown on your footnote, and then it's backing off the amounts that they're saying are not available to be used within 1 year to come to your net total that you have down here. Sorry, I keep pointing to my right because I'm right-handed, but it's the same on both screens. It's just easier for me to turn that way. So for implementation, you must show the amount of assets in reserve that aren't available. Again, that could be surprising to some organizations as you start to do this analysis. You may think you have a lot, but really when you start to back off those amounts, you realize you don't have any. Or you could sort of discover this interfund borrowing situation where you've got temporarily restricted net assets, money coming in that you know is temporarily restricted, but for whatever reason you have this shortfall on operating funds, so you've used those funds knowing that you're going to have operating money coming in at a future point to sort of replenish that. We would have advised against doing that because you can get into a situation where for whatever reason that money doesn't come through, and now you have a situation where you can't replenish temporarily restricted funds, or I should say with donor restriction funds. And so obviously that's probably going to be bad PR. Your donors are not going to like that. So it's just a situation they're going to want to try to avoid. So this could help with discovering some of those situations. You'll want to decide if you want to present a classified statement of financial position. So I would say, again, most of our clients do present classified balance sheets. However, we do have some clients that present an unclassified statement of financial position, either because they just choose to do it that way or because it's an industry standard for whatever type of nonprofit that they are, or if they have a related actual for-profit entity that's related to the nonprofit, they may have just a standard presentation that's used. But you're going to want to consider whether you want to just move to the classified statement of financial position, because that is already sort of organized in the order of liquidity. You may also want to consider if you want to establish an operating reserve, just to help with this liquidity situation. So as you look at things, does it make sense to put an operating reserve in place so that you can make sure you have these types of available funds to cover expenditures for the next year? Do you have an available line of credit? Some organizations may disclose, hey, yes, we know that we have this amount of available assets. It may look a little short, but we have this line of credit available that we can actually access if needed to cover some operating expenses. Again, probably not a great practice unless you know you can pay that money back if it's just a timing issue. As you know, nonprofits that take on excessive amounts of debt, it's usually never a good thing, especially those that are dependent on grants and contributions. Just because you don't know exactly how much that money is going to be that you're going to have coming in. It can be unpredictable. But a line of credit may be a short-term option. Do you want to invest your cash in short-term investments? Again, try to generate a little bit of investment return. Or do you want to make a change to your stock liquidation policy? So many organizations, when they receive donated stock, they automatically liquidate that and change it to cash and take that into contribution. Perhaps if you get stock and for whatever reason it's not a good time in the market to sell that, you may choose to actually hold on to that. Well, you probably have a policy that says you're going to automatically liquidate that, so you may have to modify those policies a little bit. Any questions on the liquidity and availability provision? So as part of the handouts that were provided for the seminar, when I say handouts, it's all available online, as you know. There are various resources that you can access there that should help with the implementation of some of these items. So we've included out there an implementation checklist, and I should say these resources are made available by the AICPA and by the Indiana CPA Society, basically to help organizations in these transitions. And so we've included some of those. Again, the implementation checklist sort of goes through what are the activities that you need to accomplish, what's the description and the consideration that you need to make as you're implementing this, and then what are the tools and resources that are available to you, either other people within your organization or peer networks that you have, or your auditor, for instance. And then just figuring out how you're going to go about implementing the standard. There's also out on the site a liquidity and availability disclosure, so a template that you can use to start to draft this footnote, which you're going to want to draft ahead of your audits or financial statement engagements. There's also an example functional expense statement, which you can look at and sort of decide how you want to go about implementing that internally. There's an example of the net asset presentation as well that we went through at the beginning. And then there actually is a complete set of financial statements, both in PDF and in Word. So the Word version would make it a little bit easier for you to kind of cut and paste and take out things that you want to implement and modify that. So again, you can also use the AICPA website. If you were just to Google this standard on financial statement presentation, you're going to get a whole bunch of returns, articles that you can read, things that should be helpful to you as you move through this process. So again, I would encourage you not to wait for your auditor to implement this for you. Again, we're here absolutely to be helpful and absolutely to consult with you on how to do these things. That's our job. But we cannot obviously be part of your internal control structure, so we can't be drafting these things for you and then auditing them. That would be our own work. And so your engagements for 2018 will go much smoother if you've sort of addressed these things ahead of time.